Let's hear from the next keynote speaker who is driving innovation at a large organization. He has led and advised over 200 growth projects across corporate and financial institutions, with extensive experience in the assessment and strategy design for emerging business models.
He is a member of KPMG's Global Banking and Capital Markets Leadership Team and sits on the Asia Regional Banking Executive. He is currently Global Head of Financial Services Innovation and FinTech at KPMG International and Partner and Head of Financial Services at KPMG Singapore. Welcome, Mr. Antony Ruddenklau.
Hi, everyone. Firstly, kudos to the two speakers before me. It's been great to listen to what's going on in the entertainment industry, George. Love it, love it. My daughter's a big fan of Stranger Things, obviously. And Nitin, also to hear about your views on tokenization. If anyone knows Iggy Pop in the room, who still is a very cool punk rocker, he had a song called No Fun. And unfortunately, I'm going to bring the no fun element this afternoon because my job here is to bring the voice of reason around digital assets and digital currencies and talk a little bit around where that part of the industry is going right now as we move into so-called metaverse or Web3. And what we need to do as an industry in financial services and through into real economies to be able to create a trusted, scalable, safe system for all of our users. I think the background's already been given on who I am, but just a couple of thoughts here. As I was coming over from Asia Square, it was a long commute across. I was looking at the big TV screen on Tower 1, and there's a lady called Sheila Bair on the screen being interviewed by CNBC. Sheila was the head of the FDIC at one stage in the US. And the title there was, Regulators Need to Go Further Than the Current Trajectory on Regulating Digital Currencies. The second heading as I was walking across, because I was a bit of a slow walker, was FTX was a Ponzi scheme. And I compare that with another one that I saw about 2 months ago, Celsius was a Ponzi scheme, according to one regulator in the US. So I always like to sort of start off these conversations with two things. One is the technology is awesome. My job is to innovate at KPMG International and embrace these sorts of things and bring in new capabilities into our financial services sector. Love the technology. The one thing we tend to forget is there's something called human behavior and greed out there and bad actors. And I think for us as a community of business leaders, we need to protect our users, our investors, ourselves against the bad actors. And unfortunately, it doesn't matter whether you code in Python or not, the bad actors will find a way of being bad. And that's what we need to protect against. And so what I want to talk around today is a little bit around where is the industry heading right now? What's the current state of trajectory from the regulators that, according to Sheila, are not doing enough? But anyway, I think they probably are. And how do we solve for a problem of having a Web3 that we can pass on to our children and be confident that they're not going to destroy the global economy at the same time? So if I just flick through, there you go. That's me, that's us. Right, I think everyone knows the story so far. So obviously, after the financial crisis, we had Bitcoin released and a lot of the other digital sort of assets that have acquired value and lost value over that period of time. Most importantly, we've had some instances in the market recently which have been rather questionable in terms of their motivations and their current business models. Celsius, BlockFi, Genesis, Terra Luna, Three Arrows. My estimations will probably be another half a dozen of these flush out in the next 6 months. So I think we'll have another longer list of failed businesses to be able to talk around as we walk through. Most importantly, investors still believe in the technology. So our estimations are by the end of this year in terms of digital assets and digital currencies, we'll see another 30 billion pumped into the sector to be able to actually start to create new infrastructure and the next way of working. Our institutional involvement also provides conviction around the blockchain space and long-term, long-term change. And most importantly, the regulators are now taking notice of this and starting to lean in and look to provide guidance for both investors and to safeguard those investments. In the central bank world, we talk a lot around central bank digital currencies. We have 100 such projects around the world running right now, exploring topics like interoperability, actually, but through the digital currency lens, because we all know that actually our legal systems and our financial systems do not actually work properly together at the moment. And so the likes of Nigeria, China and others have actually launched full-scale digital currency programs with very, very good results so far in terms of inclusion, usage and download figures. If I move through to then what the challenges and the opportunities are for us in financial services, and the reason I say this is if you go into the metaverse ultimately and you want to be able to trade and buy something, you're going to have to use a digital currency. And financial services will want to ensure that the rules around that trading or that use of money is risk managed. And so if we look at things like adoption at the moment, I think one of the big learnings so far this year has been very much to the lack of consumer protection when it comes to current business models. We know, for example, on FTX and the FTT token, there was a commingling of funds, and so effectively the founder and the owners of those businesses were using customers' own funds to fund themselves. That is clearly questionable behaviour, and clearly we need to be able to regulate for that and ensure that we have safe custody of consumer assets moving forward. And most interestingly, on the loss of funds so far this year, 75% of that has been the retail consumer. So it's been the punter sitting here in Singapore or in Hong Kong or in New Zealand who's wanted to make a little bit of extra cash by trading and unfortunately has been caught out by the hedge funds or institutional investors or bad actors. So this consumer protection is becoming increasingly important to the regulators. And you see here locally with the MAS saying, well, we don't want to see marketing of these types of funds to people who don't know how to use them because chances are they're going to lose money or lose all their money at the same time. Secondly, business models for adoption. I think, again, with some of the failed businesses like the digital lenders that have come out using crypto lending, most of these business models have been predicated on the bull markets. So their idea is the prices of these digital assets will continue to go up, therefore we can afford to invest in marketing and we can afford to give incentives for people to use our tokens or to come onto the platform. Or we can overpay on interest. So for example, BlockFi was providing 20% interest on crypto lending. 20%, right? That is just ridiculous. But they were wanting to do that because their business model had a hockey stick. Everything was going to continue to go up and be fine, and therefore the spread they could make behind the scenes would be good. Unfortunately, as the bull market has disappeared, most of these businesses have been found to be structurally unprofitable. This is not a problem just with crypto or digital assets. In fact, it's a problem with many new business models that rely on ecosystem or network effect or multi-sided marketplaces to be able to make money. And there's a buyer beware there for founders as well, in that Meta or Google have scale to be able to make money. But small firms who have 1 million customers on their platform probably won't make any money on a multi-sided platform. If you look at Meta, for example, I think their average user value at the moment is $15 US per user globally on their advertising funded model. No matter what they say, they're still an advertising funded model, right? No matter what they say. If you look at how that tranches out, here in Asia, the average user value, $1.35. That doesn't sound like a business to me. That sounds like it's being hedged by the US consumer who's paying $30 at the moment to Meta. So these business models need to be really clearly thought out. And most notably, if we're looking to create tokens and digital forms of money, we really need to be clear as to what that structural profitability might look like. Included in there is then obviously lack of control and governance. And I studied computer science at university back in New Zealand back in the 80s. So I did my Pascal, my COBOL, my Fortran. Probably some of you guys did as well. So I'm a little bit outdated. That doesn't make me someone who can run a bank. I can program. I can't run a bank. I don't understand the economics. I don't understand the risk management related to the risk that I'm running across an enterprise. And so what we found more recently with some of these issues in the marketplace here is we have technologists running financial institutions who don't understand value at risk or some of the basic economics around modeling their scenarios. And so I think, again, the regulators are thinking clearly, how do I regulate the people and the institution and the currency that's being issued? Now, that happens in banking right now, particularly in the UK. It's called the senior manager regime, where board level executives need to be able to attest to the UK regulators that they're running their businesses correctly. Yet we don't do that in these new emerging economy businesses. So, certainly an area which we'll see lots of heat and light on. Lastly, then, if we come to lack of trust, I think really what consumers are looking for are a few things. One is they want legal recourse, and that is very, very difficult to be able to provide right now in the current environment. Secondly, they'd like to understand what the regulatory frameworks are that sit around what they're doing. That'll give them trust around how they adopt. Thirdly, brands are important, but what we have been told by OMFIF, for example, who've just done a really good report on trust in the digital space, is actually consumers trust central banks and commercial banks far more than they do Meta. And so there's a bit of work to be done there in terms of brands being trusted and earning the right to be able to actually run digital currency across their rails. And then finally, we need intermediaries. So we need interoperability, we need bridges, and we need the ability to be able to transfer value from one digital currency to another, from one set of networks to another, or between nation states. I said this would be a bit of a downer, but anyway. In terms of regulators, few things that are happening right now. I came from the UK last year, 2019, when DM and Facebook were around. The Bank of England was concerned about trust, control, financial stability, sovereign wealth, tax take, and all that sort of stuff. But they really didn't take that sort of meta discussion as serious, or Facebook discussion as seriously as they could. I think now with market failure, even though it's small in the grand scheme of things, it's very, very large in terms of money for real people, they are being far more activist in the way that they're working. So in Europe, we've obviously got the MiCA regulations, which is the regulations to ensure that there's going to be appropriate reserves in place, that there are deposits that have real economy funding sitting behind them. So yes, create a digital token or an asset, but actually ensure that there's a real economy store of value sitting behind that. And ensure also that redemption requests can be made if people want to make mass withdrawals, what we used to call the run on the bank. Here in Singapore, we've got the Payment Services Act, so it's very clear now if you want to play in this space, you need to get a license. And those licenses are being handed out to those firms that can pass the tests. The Financial Stability Board has issued 9 high-level recommendations to promote consistency and comprehensiveness across regulation, supervisory and oversight approaches to crypto, and to also ensure that we've got cross-territory international cooperation and information sharing, and particularly that becomes relevant in the likes of money laundering or in bad actors that are using those rails for bad purposes. And then we've certainly got more work to be done yet on securities regulation, how payments, clearing and settlement systems might work, how they might be interoperable with the Web3, and how we make sure we've got trusted, innovative products happening. In terms of extraterritoriality, a couple of things to recognise here. The SEC most recently has flexed their muscles. They said with Ethereum now that given that is effectively a US-based capability, that anyone using Ethereum globally will need to comply with SEC rules. And we're probably going to see a bit more of this going forward, where local sovereign nations determine in their national interest that they want to ensure whatever crypto digital is coming from their state, that it is under their purview. We're yet to see what China is going to do. Obviously, we have a digital version of renminbi versus greenback that's about to appear, or has been appearing for a number of years probably. But you can bet your bottom dollar there is going to be a bit of a bun fight between those two nations on who owns the crypto, who owns the IP, who actually owns a regulatory framework around this new world, and really where does the Web3 or the metaverse live? Is it in Silicon Valley or is it in Shenzhen? And I think here in Singapore, we obviously are the Switzerland of the South, of South Pacific. We need to play both sides to be viable going forward. So extraterritoriality will be important. Hong Kong, Singapore, and Switzerland all have similar aims in terms of how they ensure their economic development and the well-being of their citizens through the next generation of digital assets is looked after. And then finally, in consumer protection, I mentioned that before, few things to realise. We need to ensure that trading via credit in crypto is restricted. We need to put in some very good Basel-type regulations there, just some sensible stuff so that if people are trading, the firms they're trading with are not over-leveraged, and therefore they lose their money. That's the first thing. Secondly, we need to be able to assess how customers work. Are they fit and proper to be able to use crypto? Do they have the knowledge? Do they understand the risk that they're running? Much like what we do when we do our financial analysis right now for our own pension funds. We need disclosure on reserve backing. Certainly KPMG has been, let's say, deluged recently with proof of reserve requests from particular actors in the market wanting to ensure that they've got that kind of bill of health, particularly stablecoin providers. And then finally, we need that segregation of assets as well. So if our money is being put on an exchange or if it's being used by some type of digital fund, we know that there's safe custody. We know if that fund or that business goes down, that our money is going to be safe going forward. And so the likes of digital custodians will become more prominent going forward. Final one, if we just look at then, where do we need to go as Web3 companies to address these risks to get more trust in the system, to enable to scale quicker, to be able to create a new viable set of digital economies and business models. We've really got 4 risks that we need to be able to address. The first one, as I mentioned before, is money laundering, terrorist financing. It is unfortunate that parts of the system have a lack of control at the moment, and clearly there are some bad actors using parts of the system to be able to finance bad things that cause ill to consumers around the world. There's a risk of contagion and financial instability. We need to understand how that works, what are the dynamics of the so-called crypto, and how do we put fire breaks in place around the global economy to ensure that if we do have something happen, then that's not going to be bad for everybody in the system. Technology and cyber-related risks obviously need to be addressed, and I think we see more hacking at the moment as we have our so-called crypto winter. And then finally, instability of the digital currencies like stablecoins, I don't need to go through too clearly, but really the major issue across all of this, there is not enough liquidity in the system. Traditional banking requires liquidity to be able to maintain stability across the globe. And simply by having some tokens that have no store of value behind them does not infer enough liquidity across the ecosystem or within any one organisation to ensure if one part of the ecosystem goes down, the rest is protected. If I just talk a little bit about some of the points on this particular slide here, obviously money laundering risk is important for us to be able to safeguard against. As everyone knows, only 56% of the world's economy goes through legitimate banking rails. 44% goes through black and grey economy, which is always a worry. But for that of it that's going to go through these new rails, we need to ensure there's enhanced customer due diligence. If there are risks in the system, those risks are shared across the system as much as possible. We need to ensure also that there are disclosures made to retail consumers so they understand what type of organisation they're working with and how those organisations are protecting their own interests. This is obviously not just a cryptocurrency issue. My mum spent $8,000 recently on a boyfriend in Nigeria. I don't need to go much further. It's personal for me. So, Mum, don't do that again, please. Financial stability. It's a second area we really need to understand. And I think, really a few examples of areas where I think we can address things quite sensibly. So, we need to offer collateralized lending, deposit-like services through crypto asset service providers. We need appropriate underwriting and placement and market making with traditional instruments backing the crypto assets for the time being. And then also we just need to make sure that there's much more linkage between traditional banking and financial services in this new economy. And I think recently at the Singapore FinTech Festival, there was a stablecoin session that we were involved in with Circle, Paxos, Coinbase, StraightX, etc. And much more focus now with recent issues on collaboration and coexistence of stablecoins, central bank digital currencies, fiat currencies, rather than the so-called disruption play that we probably would have heard about 2-3 years ago, which just ends in tears. In terms of cyber-related risks, we obviously need to ensure that if we make our money digital, that there's appropriate tech and cyber risk management, particularly when it comes to things like coding bugs and smart contracts. Those things do happen. And if we have digital token wallets, that there are appropriate safeguards around their encryption keys as well. Need to ensure that availability and recoverability remains high. One of the things we've been speaking to the FCA about recently in the UK, post Wirecard, which was not a crypto firm obviously, was to ensure that actually there is a digital carbon copy of every financial institution that maintains all transaction history. So if the system, or the player goes down, we still have enough information that's recoverable to ensure that actually we can continue service, and also consumers don't miss out, and consumers being businesses as much as retail consumers. And then finally, we need to ensure that anyone that goes on into the metaverse or provides Web3 currency services has a third-party assessment of their security protocols and resiliency of their infrastructure, so they don't present risk to the wider ecosystem. I've mentioned safeguards for investors, so I won't really go through that much further. Final one, just going forward then, just in terms of way forward on how this might work. And by the way, I just want to say, we are very bullish on the technology. What I'm trying to give you here is a view that we have risk at the moment in the system. We need to appropriately regulate, as Nitin said, to ensure actually the value is created and sustainable going forward. Otherwise, it will go down the drain, literally. So through the crypto downturn, a few things have happened. One is good businesses have got better. They've remained lean and stable, and they've proved their business model. And I'm talking about certain exchanges and certain large crypto firms out there who have shown that they actually manage risk appropriately. They have appropriate governance in place. So that's a good thing. Those businesses have been tested, but have proven that they're worth it. I think regulated digital currency does offer high promise for cross-border opportunities. So we see here again with Project Ubin or Partior or other Bank of International Settlements projects that cross-border payments for SMEs in particular is a good thing. It improves time lag, improves working capital, and provides stable, efficient, and coherent payment methods. So those sorts of projects I think will work very, very well, and particularly here in Southeast Asia, where we have a high degree of SMEs who are underserved by traditional banking services. This is a good thing. Stablecoins have a real potential, we believe, to be a high-quality medium exchange in the ecosystem. MasterCard has been popular with its own stablecoin issuance and their payment service. But to reap the benefits of stablecoin, we need those stablecoins to be stable. The clue's in the name. And we need to ensure that those are well regulated. They're backed by high-quality reserves, appropriately tested, and ensuring that their utility value is retained. And then finally, asset tokenization. I noted with interest earlier on, Nitin was talking around financial instruments being tokenized, and he was also talking around physical instruments being tokenized. And at KPMG, we see a huge amount of value in tokenizing physical assets. That's probably where the next digital transformation comes for the metaverse. And so these areas need to be explored, and they are being explored right now. But the likes of fractionalized ownership over the internet on peer-to-peer basis, these things are good to open up investment, opportunity, liquidity, and to democratize services for all. Secondly, we see an opportunity for these assets to be traded securely without the need for intermediaries. So again, Nitin said, cut out the middleman. That is the opportunity going forward. This could be anything from supply chains, where there's a high degree of overhead cost at the moment in paperwork, through to the likes of mortgages, or it could be around rural financing. And then to enable decentralized finance, where lending, borrowing, and trading activities can be performed, we really do believe in smart contracts being part of the answer here, as long as they're appropriately audited, there are relevant risk and controls around those. And in fact, one of our core banking providers that has done very well here in Asia, Thought Machine, if anyone knows them, they rely on smart contracts already for their core banking product. It is a high-quality product and appropriately risk-managed. So I just wanted to sort of finalise with a couple of thoughts. For me, this is all around risk and reward. We need to provide balance going forward to ensure that we retain investment, we get return, we look after ourselves. Secondly, we need to ensure that policy is well thought out. I think it would be fair to say most people in this room would have views on really poorly thought out regulation, and there is tons of it around, so there does need to be a high degree of thinking and a high degree of engagement between real economy, the so-called Web3 metaverse bros, as you call them, and also with the central banks and other actors. That needs to happen, and that should be good. And then finally, we need to continue to experiment, but experiment in a controlled, effective way so we can understand the risks, rewards, the economic returns that we're all seeking to achieve, and therefore we can go forward with confidence. So I'll stop there. Hopefully that was useful. There was no Mickey Mouse in there, unfortunately. I apologise. Yeah, mate. Yeah, thank you. But hopefully that provided some light and shade versus the past two presentations as well. And hopefully also just gives a sort of modicum of balance in terms of how we need to look after ourselves. Would anyone have any questions? I will join the panel later and I'll be a lot more happy.
Testing. Yeah, just one question. You mentioned right at the end there that we need to be able to experiment, but do so in a controlled way. Where does that trade-off sit for a consumer-facing product, for something that the average Joe is going to be involved with?
Yeah, it's a really good question. I think, without stealing the sandbox phrase from Sandbox, at the moment, the industry is unregulated largely. Although there are regulations placed on it, but let's say it's unregulated. And so unfortunately the experimentation happens on real investors. If you sit within my traditional world of banking, most of our regulators around the world have digital regulated sandboxes with real data, potentially real customers as well, and you can actually trial out your new product and service, and that can be observed. And once it's proved that works, and typically we're talking about algorithms and business logic and maybe the economics as well, then that gets rolled out, that particular product safely. I think we need to bring that into the metaverse and the Web3 space as well, purely because I think what we're developing is a very interconnected set of capabilities. It does have value attached to it, no matter whether you're sitting in a virtual world or not. There is value, money, and I believe we need to be able to put those sort of belt and braces around it. I do a lot of work in mainland China with unnamed firms. I won't say who they are, but I see the regulators every week up there on producing new capabilities and ensuring that they lay their hands on it before it rolls out to the other billion users that we might want to go after. I can't see why we shouldn't be doing that in this space. Maybe not with certain parts of entertainment and media, but certainly when it comes to funds and money, I believe that we should have equivalence between traditional financial services and new. There is a real strong debate in my community around encouraging innovation. Good thing, right? Actually, some innovation is not good. We've just seen that. But encourage innovation, but also ensure there are some belt and braces that are appropriate to support those entrepreneurs and founders, but we don't present systemic risk to people in the future. Any other questions?
Great talk, by the way.
Thank you.
More of a clarification question. On one of your earlier slides, when you showed the state of the industry, I think it was slide 4 or 5, you talked about $30 billion, I think, in PE, VC, and other money still to go in.
That's right.
I think your slide said it was 22. Was that did you mean 22? Or
no, we meant 22. So we're almost there. We're almost at the end of 22.
That's the reason I'm asking.
Yeah, so just to be open there, I use PitchBook data, the Morningstar company. And we actually already have the data because we kind of believe there's not many deals left for the rest of the year. So that's roughly where it's heading. And I think the big areas that PE and VC in particular have kind of repointed their money towards, because there was a lot going into flaky exchanges and sort of front office crypto funds and all that sort of stuff. They removed all that money and they've put it into digital infrastructure, digital identity, risk management and cyber. And I think that's a really wise thing for, I'm not going to name the firms, but for these firms, because what they're betting on is actually we need to go through an infrastructural system change to be able to enable everything that's been spoken about today. So they're making that bet that this is 10, 15 years of infrastructure build, and they'll reap the rewards that way. It's inward investment from the investor community into money right now. So it may not have been spent yet. I hope it hasn't. But certainly I think it's just a bellwether for the fact that the investors still see a huge amount of interest here. And what I try and do in my other life, when I'm doing the fun conversation, I'm doing the DAO one today, the fun conversation is that actually investors truly believe in this. We talk around crypto winter. What we really mean is asset values are down, whether it's public or private asset values on these businesses. We talk around fraud and malfeasance that I've been mentioning, not being good. And we say this is a crypto winter. Yes, it is in that respect, but investors are still going hard on this. They believe this is systemic change, and they have a longer term thesis than quarterly analysts sitting at, name the investment bank. Yeah. Any other questions? Have I killed it?
We're at time.
Thank you. Thank you very much. Thanks.